In the week of October 28, 2025, the People's Bank of China (PBOC) announced the injection of 2.068 trillion yuan, approximately 285 billion United States dollars, in liquidity into the domestic financial system. This marks one of the largest single-period monetary expansions China has executed in recent history, explicitly aimed at stimulating the Chinese economy, which continues to grapple with weak domestic demand, a fragile property sector, and persistent deflationary pressures. Although targeted at the domestic market, this move carries systemic global implications. Historically, when major economies, especially the G2, US and China, expand liquidity, excess capital tends to flow into higher return assets, including equities, emerging markets, and crypto assets. The logic is straightforward. More money in circulation lowers the cost of capital, weakens local fiat currencies, and encourages investors to seek non-correlated or programmatically scarce assets. In the current context, China's liquidity injection comes at a pivotal moment of global monetary policy divergence. While the U.S. Federal Reserve has signaled a pause in its rate cut cycle after a 25 basis point reduction, China is opting for aggressive, preemptive stimulus, anticipating a deeper economic slowdown. This contrast between monetary stances, relative tightening in the U.S. versus easing in China, could trigger significant cross-border capital flows, particularly toward liquid and globally traded assets. For cryptocurrencies, the potential impact is clearly positive. Global liquidity is one of the primary catalysts behind Bitcoin's and other digital assets bull cycles. When capital is abundant, both institutional and retail investors tend to allocate increasing portions to alternative assets in search of hedges against currency depreciation and returns superior to traditional fixed income. In this environment, Bitcoin, with its hard cap of 21 million units, stands out as a global, political store of value, especially in a world where fiat currencies are continually expanding. Moreover, China's liquidity boost could indirectly strengthen crypto markets across Asia, a region that hosts much of the world's mining infrastructure, blockchain development, and stablecoin demand. Although China maintains official restrictions on cryptocurrency trading, its monetary policy directly influences regional markets, including Hong Kong, Singapore, and the UAE, emerging hubs for institutional crypto adoption. It's worth noting that unlike direct fiscal stimulus, this liquidity injection occurs through open market operations, such as bond repurchases and short-term loans to financial institutions. This means capital doesn't flow directly into the real economy, but enhances banks' capacity to lend and invest, which over time translates into greater availability of funds for all types of financial assets. From a macroeconomic standpoint, China's decision reinforces a global trend. Major powers continue expanding their balance sheets in response to structural stagnation and geopolitical volatility. In such an environment, scarce, decentralized, and government-independent assets like gold and increasingly Bitcoin tend to appreciate during prolonged monetary expansion cycles. Thus, while the immediate market impact may be moderate, the signal from the PBOC is unequivocal. The world is still printing money, and investors are watching closely for assets capable of preserving and even multiplying value in this new era of abundant liquidity. In this context, Bitcoin is not merely a speculative instrument, but a logical response to contemporary monetary policy.